Developing Markets Associates, we are an international development consultancy. We really work in three main areas to attract funds into developing countries, and they're quite different activities. One is we work with a lot of developing country governments to help them promote large ticket items to the international investment community, particularly here in London, but also in other places around the world. So as an example, last week we had the Prime Minister of Côte d'Ivoire and a number of his cabinet ministers here to present a series of investable projects, all in the tens of millions of pounds, to the international investment community. And then from that, we will then continue to work with the government to help them actually cement or seal the interest that has been expressed at those events. So we're really helping at the top end with the large ticket items. The other area that we work in is at the lower ticket value, which is really in international remittances. And there we work very closely with governments, with organisations like the World Bank, with private sector companies, to really try and improve the environment through which individuals who have often at great sacrifice moved from one country to another can maximise the amount of money that they send home. So the tactics or approaches we use range from advising governments. To give you a couple of examples briefly, one, any of you who are involved in the remittances business, and I'm not sure if any of you are, will be aware that here in the UK, it is now nigh on impossible for a money transfer company to obtain a bank account. We've been working with the government here to try and advise them how they can actually get over that hurdle. And in fact, yesterday there was a court case that was resolved. In the interim anyway, an injunction was won by a money transfer company against one of the banks in the UK for closing those accounts. Another way we do that is by providing information to remitters on the cost of remittances, with the aim of working with the G20 governments to reduce the price of remittances, because at the moment the global price is about 9% of the face value to send $200. Now, I know we've got some fund managers in here, and I don't even think that your fees are at 9%. But if you imagine what 9% to somebody who's worked hard and is sending home $200 or $300 is worth, if that could be halved, that would put something like $40 billion back into the hands of the people who are sending money. And if we could then harness that $40 billion into home strings and the associated projects, imagine the difference we could make there. So actually this particular event today is absolutely fantastic for DMA. Not only are we working with Eric and his team, but actually it brings together the two strands that we work on, because actually what we're really saying is these initiatives will help developing countries, but actually the people who can invest are actually the people who are remitting their money. And what's interesting, remittances is estimated to be about $550 billion being sent around the world at the moment by 232 million people. What is not probably known quite so much is that it is estimated that there's over $400 billion in savings held by diaspora members outside of the countries that they come from. So that's in addition to the remittances. So that's why this is so good from our viewpoint. It just fits perfectly. We're enabling a whole new class of people to be able to increase their wealth and support the countries that they've come from. So that's the end of the sermon on DMA. And now let's move on to this particular session, which is all about real estate. And again, this actually links back to the individuals who are sending money, in a sense, because often the first use of remittances sent home is for subsistence purposes, food and so on. But the second reason is nearly always around housing. And one of the things is that people will send home incremental amounts to enable them to build a house for when they return home. Now, what we're going to talk about here is much larger and is going to cover capital projects like hospitals and hotels and so on. But also we're going to talk about some opportunities around individual house developments or building of infrastructure in urban areas and so on. So it's going to be very fascinating, and I think the key thing is we can all relate to housing. So, not all of us are necessarily gold miners or oil well diggers, whatever the right term is. See, I'm not, but just proving my point. But I think the key thing is that we can all relate to this. And so I shall stop now because I know we're quite tight on time. But the other thing some of you know about me is that I am a qualified football referee. And I'm not of the Alex Ferguson type, so of manager. So we do now have a yellow and red card system for our speakers. So when the yellow goes up, you've got 2 minutes. When the red goes up, that is the end of your slot, regardless of where you are. And not only will we pull you off, we'll turn off the microphone as well. So you're all warned. But having said that, I'm delighted to say that Randolph Rodriguez from Stanbic in Ghana, who we heard from this morning, is now going to talk to us very much about the real estate landscape in West Africa. So, Randolph, the floor is yours.
Hi, good afternoon. I hope you're all well fed. Okay. I'm going to prepare this now. All right, so I thought this slide was particularly instructive, so I'm going to start off with this. I live in Accra. Kumasi is another city in Ghana, the second most populous and the second most commercial of our cities. And it's interesting to see Accra compared to Johannesburg. They're about the same size population-wise. But if you look at the office, retail, and hotel availability in Accra relative to Johannesburg, it highlights the huge dearth of infrastructure, residential and office infrastructure that's available in Accra. And this is part of what has driven the huge boom in construction in Ghana. I met someone several years ago who told me his job was he invested in dollar-generating real estate assets in Ghana, a Nigerian gentleman. And I asked him what that meant. He said, I just buy apartments and rent them to people who have dollars to spend. And that's actually been what a lot of people have done to generate fairly attractive returns. And so there's a clear gap here that needs to be addressed. What this doesn't show is the residential situation, and that's even more extreme. The government estimates that they have a shortage of over 400,000 homes, and for a population of 24 million people, that's quite significant. So in terms of the key trends that we're seeing in the market, the office developments, a decade ago, most offices were sort of either owned by the people who were living in them. So the companies that were doing well would essentially put up buildings that they would occupy themselves. Most other companies would have to rent small houses in residential areas or small office spaces that were built of fairly poor quality. Increasingly, we're seeing more grade A type buildings, high quality office space available for occupation by credible institutions. On the residential front, Ghana is really a flat country from a housing perspective. So most houses are single family, you have your plot of land, you put up your own house. Now, because of infrastructure concerns, the infrastructure is not spreading as far as you would like to facilitate growing population. So there's an increasing tendency for development of multifamily residences, so apartment buildings, townhomes, and so on, and that's been growing in the last couple of years. On the retail front, we now have Accra Mall, which was built several years ago. When I left Ghana 15 years ago to go study overseas, if you wanted to buy anything, you'd go to a market. right? So an outdoor market, and that was the only way you could actually buy stuff. Retail stores were sort of standalone, so you'd have to know where a specific store was to acquire something. There's been the Accra Mall, which is sort of the largest mall in Ghana, was built recently, and it's seen extremely huge foot traffic, and there's growing development of the formal retail channel. So we're getting supermarkets and so on, all of which have more or less been built in the last 5 years. On the hospitality front, growth in foreign direct investment, growth in international interest in Ghana has driven significant interest in need for hotel space. So on the first slide, I showed the shortage of hotel rooms in Ghana. There's only about 1,900 hotel rooms in Accra, compared to 5 times that in a city like Johannesburg. So you have a hotel like the Movenpick, which is sort of our new flagship hotel, which is 90% plus occupied perpetually, fairly attractive room rates. And part of it is because there just isn't an equivalent quality of hotel anywhere else in the city. So you have sort of one institution benefiting significantly from a growing demand for this resource. And on the industrial front, as far as manufacturing is concerned, there's never really been a culture of building fit-for-purpose facilities. So a lot of companies come and have to build their own infrastructure, their own factories, their own offices, their own infrastructure to operate from. So that, again, is sort of a new and growing trend. In terms of the recent development, there's been quite a significant amount of development in real estate infrastructure in the past few years, and there's even more planned going forward. So between Accra, Tema, and Kumasi, which are probably 3 of the main cities, we're looking at numbers that are significantly, in the bottom half of this page, significantly in excess of what's been done in the last 5 years. And we continue to see a growing pipeline of activities that are planned. Now, one interesting thing about real estate, for a lot of these commercial developments, there isn't an open opportunity. So you don't hear that someone is trying to do something and there's an opportunity to invest marketed. Typically, in the banking sector, you see equity has been raised and there's sort of a funding need on the financing side. It comes to the bank, and that's when financing gets plugged in. But the opportunity is certainly there, and so just understanding where there's a need in the retail space, in the office space, in the hotel space, it's fairly easy to see where you can deploy capital to participate in the real estate sector. We considered, what the operating climate in Ghana is doing, the impact it's having on real estate development. I think politically and from an economic perspective, Ghana is doing, notwithstanding a few very obvious challenges, it's doing a lot better than it has historically. From a political perspective, it couldn't be any better. From an economic perspective, we've had probably a down year in what has been sort of a recent history of successful economic reform. All of these things are contributing to making the climate for investors and international institutions a lot more attractive. And there, sort of the inflow of these professionals is driving a need for improved real estate to support their operations, but also from a residential perspective, people are comfortable to a certain way of living, and those who are not comfortable will aspire to a better way of living. And so there's just a need for not just low or middle class housing. There's also the need for high-end housing, which has been serviced by a lot of new developments. And then as far as the industrial perspective, because of the influx of new companies and so on, there's an increasing need for office and retail space. On the energy and infrastructure side, this has had a somewhat limiting impact on the growth of real estate in Ghana. Obviously, in order to have residential real estate expand, you need to provide roads, provide water, provide electricity. And while these are growing, they haven't grown fast enough to keep up with the demand on the market. Now, there's significant investment on all these fronts, whether it's from the government, the public sector, or from the private sector, into upgrading the infrastructure and expanding it such that there's adequate support for growth in the real estate market. And then, all this is not possible without financing. The capital markets and local bank funding have far exceeded where they were, a decade ago. There's been growth in our capital markets. Our equity market is still fairly small. Our debt markets have not been particularly robust up until recently. So there's growing demand for opportunities for capital raising, and the financial sector is tapping into that. We're also benefiting from significant interest from developmental financial institutions who are looking at, affordable housing. They're looking at infrastructure and so on. So the increase in availability of capital into the market is supporting growth in the real estate market as well. An additional development from a financial perspective is the growth of the mortgage market. In order to obtain a house in Ghana, historically, you'd have to have the capital yourself and take 5-10 years to build a house. And if it were an office, you'd have to deploy 100% of equity yourself as a company to do this. There's been sort of growth within the banking sector, but also of independent mortgage companies that are providing the capital that can now support further development of the sector. And in terms of providing some perspective, on this slide, the yellow, so the white area is sort of what is the current central business district. So that's the hub, that's where the ministries are, that's where the banks are largely located. So there's sort of a concentration of commercial real estate there. The yellow area is the new emerging central business district. So Stanbic, for example, has put up a new office that's located in that area. That's also around where the Accra Mall is, and it's extremely proximal to the airport. So for purposes of business and so on, it's a convenient location. Now the blue area highlights where most people are living. Because of the concentration of commercial activity in the white and yellow areas, obviously rents are very high. So most people are living in the blue areas and moving in to these very two focused locales to work. What this means is that there's an opportunity for development outwards. So to the extent that you can put an office in a densely populated residential area that's 20 miles outside of Accra, clearly there's adequate population in those areas to support, whether it's your retail outlet or your office or your business, whatever it is. And so we're seeing that particularly in the retail space. So with formal retail, malls are being built further and further away, sort of across this blue area. And this is just looking at Accra. There's a similar dynamic in all the major cities in Ghana. And so this is where the growth is going to be taking place. Let's get this. From an investor's perspective, one thing that's been needed is because of the perceived risk in the market, there's typically a high requirement of equity investment to support a project. Now there's two ways to look at this. One is from the perspective that as an investor, you have to aggregate significant amounts of equity to support a real estate project. The positive is that it means there's a lot more opportunity to deploy equity capital into real estate projects. You'll see the debt tenor is fairly short. So, for an average mortgage in Ghana, you're looking at, this is just debt. So you have to, you put up a facility and you have to retire it after 5 to 7 years. And for real estate, because of the relative difference between the huge amounts of capital you deploy to put up a facility and the annual streams of rent you get, you typically need a lot longer period to eliminate whatever debt you've incurred to put up a facility. That's what drives this high equity demand. But that said, there's also a very attractive IRR to be generated from real estate projects. So to the extent you're looking at putting in money and generating 20-25% returns, it's actually a very interesting space to participate in. And these returns apply across board. So whether you're looking at commercial property, residential property, and regardless of size. So, the 50 million office development probably can generate this just as a small 4-person residential facility does. So there is a lot of opportunity in this sector. And there are a couple of companies, both international and domestic, who have tapped into this wave of opportunity. Actis and Atterbury are probably at the forefront of the developmental wave. Actis through Laurus, their real estate fund, and Atterbury, which has been participated largely on the retail side. Novaria and Grapnel are also companies that have participated very aggressively in this space on the international front. From a domestic perspective, what typically happens is that companies that have absolutely no affiliation with real estate, they're operating in oil and gas, operating in mining, operating in packaging, generate significant capital, and they deploy it into real estate investments because of the high returns that it provides. And so each of these companies, I guess with the exception of Primrose and Trisaco, Gold Key in particular, it's originated from an oil and gas company. Primrose has some affiliations in the financial sector. Main Investments, likewise. Trisaco is exclusively property development. So all these companies, in addition to many more, are actively involved in developing projects, and most of these are residential as well. So, okay, thank you.
I was trying to be
perfect. Okay, so there's opportunity for all these guys. They're all involved in development spanning the breadth of construction and so on. And so there's opportunity for involvement either directly with them or to start something on an independent basis, leveraging sort of the blueprint that they have laid. So that's really all I have to say on this. And I mean, as far as when you look at nothing comes without challenges, but so land acquisition, construction, financing, management, and exiting your investment. These are the things that one has to be cognizant of for making an investment in Ghana. And they're all fairly weighty. I'm happy to discuss them at length to the extent that people are interested. But these are some of the things you want to be cognizant of looking at the space. Yeah.
Randolph, thanks very much indeed for that. I think that was really clear and sort of sets out the opportunities. And I know you didn't have long for the challenges, but are there any burning questions that we have for Randolph at this stage? After each presentation, we'll have a short Q&A specifically for them, and then we'll have a sort of more general Q&A, time allowing, at the end. So are there any burning questions? Eric has one. I can see a hand. I'm sorry, I can't see the rest of the body. Here's a gentleman back there as well. So you go first, and Eric will come to you. If you could just say your name, and if you have an affiliation, what that is, that would be great. Thank you.
I'm Amilcar van der Horst, and I am linked to Kairos Society, which is a global network of elite student entrepreneurs. And the problem I see with investing in property in Ghana is the infrastructure has not caught up with the opportunity that exists. How will the infrastructure be able to reach Accra, Koforidua, Accra, Paga, Accra, Tamale, Accra, Takoradi, Accra, Kumasi? The Accra-Kumasi road has been under construction for 30 years. And there are always potholes in it. How will this be solved, and how do you see that emerging, and how will that affect real estate investment in Ghana?
Am I on? Okay, great. Yes. Yeah. A quick question. We've seen a spate of new laws, Ghana, Nigeria, Kenya, introducing real estate investment trusts as listed vehicles. Can you talk quickly about what that means in terms of capital formation domestically and internationally? Thanks.
Thank you. Any more questions at this point? Going, gone. Right, Randolph will come back for more questions later, but perhaps you'd like to address those two quite different questions.
Yes. Okay. So I think of to address the challenge of infrastructure catching up, it's not perfect, but I don't think there's anywhere else you can make the kind of returns that people are making on real estate in Ghana at this point. Now, I think, the Kumasi Road and other roads, water, electricity, those are all long-term things that are being addressed by the government one way or another. Some of them will happen in a year, some will happen in 10 years. I think what's important is to understand the market, understand where people are living in Ghana despite these issues, right? So people, whether or not the Accra-Kumasi Road is constructed, people are still going to have to transport gold from Kumasi. People are still going to have to transport raw materials and imports from Tema through Kumasi to get to the north. People are still, living in these places, and our population is growing, not insanely fast, but 2 to 3%. FDI inflows are growing, increasing numbers of foreign institutions coming into the country. So there's clearly a demand for these things. So I think what it means more than just that it's a problem is that real estate presents an opportunity, but these are all opportunities for infrastructure development. And so you find that some developers are taking on the task of addressing both. So in the case where you're going into an area where there's no water or there are no roads, you price in the cost of developing, digging wells or laying not necessarily asphalt roads, but whether grading a road through the community. So those are all ways where you're addressing a long-term problem with a short-term solution that will eventually be addressed. We hope sooner rather than later. And people realize that it's an issue. You price it into the cost of development, and people pay the price. So, from the perspective of a developer, it's just something that you have to deal with doing business in the country. And I think it's kind of an issue that will cut across. It's just part of the nature of doing business in a place. You have to deal with the inconveniences and in this case, it's a lack of adequate infrastructure, which. So on the REIT front, so Nigeria has recently passed a law and done their first REIT. Ghana is in the process of doing the same. In Ghana in particular, SNIT, which is our national pension trust, holds significant volumes of real estate. So a lot of the old central business district is actually in their portfolio. And so they're working on establishing a REIT so they can offload some of this as an opportunity to raise capital, which they can then deploy into other avenues. I think, the import of this is across the West African sub-region, there's growing capital, but there's, more importantly, there's a need for equity, for assets to invest in. And REITs present a fairly secure way to make sure you're getting your capital. All the capital is paid out at the end of the year, and so you're not necessarily putting your money in someone's hands for an extremely long period. The capital that's generated is going to continue to grow as real estate assets grow, and they can roll more and more of these assets into the formation of REITs. And that tied in with pension reform in particular is interesting because historically, the capital, Nigeria is several years ahead of Ghana in this regard, but it's following the same trend where there's almost a large single pension manager that has been split out into several pension fund managers, all of whom have the mandate to deploy capital seeking a return. And to the extent that that they can participate in real estate not by actually putting up facilities themselves, but by investing in a security that's listed somewhere, it opens up the market to people who don't necessarily want to take a risk on a place with no roads, but are happy to invest in a REIT that has shown steady performance over time. So it's certainly attractive as an opportunity for investors, both in the region and outside, to participate in the capital markets in the region. So.
Great. Randolph, thanks very much for that. It's good to hear some very sort of pragmatic, how it is type of advice on that. So it's really helpful, thank you. And again, we'll come back for more questions at the end. Now moving along to Humphrey Nugo, who is the manager at Afrexim, which is the African Export-Import Bank. I'm delighted that Humphrey has joined us from Cairo, although he is originally a Nigerian from the eastern part of Nigeria. He now spends most of his time in the metropolis that is Cairo. So I think a good contrast to Lagos anyway. And Humphrey is going to talk to us about a specific opportunity here. So I won't say any more and leave the floor to you, Humphrey.
Thank you so much. Thank you. I'll be talking about construction tourism linked relay facility, which is a special product that was developed by African Export-Import Bank to overcome the challenges, some of which Randolph Rodriguez has highlighted, which has to do with deficits in supply of rooms in Africa and West Africa in particular. So how does this work now? Yeah. Yeah, as I said, it's dubbed CONTOUR, which stands for Construction Tourism Linked Relay Facility, which is a product that was developed by African Export-Import Bank to assist in transferring risk to parties who are best able to bear it. To put that in context, African Export-Import Bank is a trade finance bank developed under the auspices of African Development Bank to focus on trade and trade-related financing. So what that tells you is that real estate is probably not our forte. We do not have the capacity to manage pure real estate risk. However, we found that this gap in supply of rooms is such that could hamper the ability for trade development, because for people to develop and interact on trade, they need to travel from one city to the other. So this could be a major challenge. So the bank came up with this product. And as I go along, you would see how this is designed to make you think a bit differently, to see the opportunities and how you can leverage your real estate assets, even though you don't have equity funds to develop hotels. By way of introduction, I've seen that a couple of people don't know who Afrexim Bank is. As I said earlier on, set up in 1993 by African governments under the auspices of African Development Bank. What happened was that AFDB, as we know, was set up to focus on long-term infrastructure finance. So during the Latin America debt crisis of the late 80s, they realized that African banks were unable to access funding from offshore because of their capacity. So they spoke to a couple of African governments to say that there was a need to set up an entity either as a department in African Development Bank or an independent entity to focus on trade and trade-related financing, so that African banks, in order to provide credit enhancement effectively to African banks to leverage. We are headquartered in Cairo, Egypt, branch offices in Abuja, Nigeria, and Harare, Zimbabwe. The Nigerian office manages the West African transactions, whereas the Harare office manages the Southern Africa. Shareholders include African governments, African financial institutions, as well as non-African investors. These are the ratings, obviously not the AAA that African Development Bank was talking about earlier on. But as they say in my country, if you buy a sandal, it means that you've promised that you'll buy a shoe one day. So we are saying that we are keeping touch, and we hope that we'll get a AAA rating in the not so distant future. Yeah, I think I've spoken about the purpose. I'm mindful of the red card that my referee has. So So, why tourism? Because, as I said, we recognize that the impact of a unit of investment in the tourism sector reverberates throughout, and the opportunities in that area, given the ease of air travels, the growing middle class, as the speakers in the morning highlighted, are so huge that we cannot ignore as a development finance institution. So for us, it has to do with both the development impact and service exports. WTO released a report which says that by 2020, there will be at minimum 1.6 billion tourism landings globally. So the idea is to position Africa to take a pie, a piece of the pie. Now the issues. These are the issues that we thought African entrepreneurs are faced with when they want to engage in hotel transactions. First of all, they don't have equity funds. Some of them have land, they have real estate by way of land, but they do not have the equity funds to develop it. As we've seen earlier on as well, there is a high perceived country risk in most of African countries, political instability and the like. Somebody was telling me about Boko Haram in Nigeria today. People talk about Cairo, that's where I live, as if the whole city is under fire and under siege. But we are able to do our business. And I think the entire risk perception about Africa is highly exaggerated, and that is the truth. As I said, I'm a Nigerian, pretty much complicated country, you might say. And I live in Egypt, another country that has received a lot of attraction in the recent past. But I can tell you that you can still do business there and make money. So the perceived high country risk is another challenge, militating against the ability of entrepreneurs to access funding for hotel projects. Then the projects themselves, the completion risk, obviously a lot of things, government interference, cost overruns, difficulty again to access funding, construction risk itself, the challenge, part of the challenges that these guys face. Then the operating risk, capacity and the skill set for the would-be hotel owners to manage the asset. Now, again, it is almost impossible to access term financing of 7 to 10 years in Africa today. So it's in the context of these challenges that Afreximbank developed this construction and tourism linked facility. And you will see how this product is designed to overcome each and every of these challenge. What we've seen is that there is appetite for 2 to 3 year funding in Africa, or beyond that, it dries up or it becomes very difficult to access, except indeed if you are a AAA rated company, or maybe you have very high capacity. We have also seen that the property prices obviously are on the northward swing. They don't drop, they're very firm. We also know, as Randolph mentioned, that for a 4-star offering today, the occupancy rate ranges from 70 to 80% across most of African countries, and are going to pay anywhere between $300 and $600 for a night, which represents a very huge opportunity. We know by our charter that we're able to offer country risk guarantees, which obviously is designed to manage the risk of the perceived risk of doing business in Africa. As a trade finance bank, we do not have expertise to manage construction risk. So we designed this product to transfer the construction risk to someone who is better able to manage it. Now, this is the product itself. Point one is where Afreximbank says, first, obviously, the party that wants to borrow would have come to us to say, I want to build a hotel in Lagos, for instance. And we will tell the party that we cannot manage construction risk. In effect, we cannot give him money for the construction period. However, we are able to credit enhance his ability to borrow money for that period. So we will put in place a standby letter of credit, obviously, of a multilateral agency like Afreximbank. And he will use that as a security to access construction loan. So the standby letter of credit, what it says is, if you deliver to specification, get your money from wherever, whoever gave you the funding, whether the developer, whether a loan bank, whether a bank or a financial institution, if you deliver to specification, and the specification will be determined by a hotel manager that will be pre-approved, then an engineer who will tell us exactly how that process will run. This SBS will be triggered and will pay the developer. In effect, the developer can give a loan for 2 years or 3 years. Then we'll pay on the SBLC and book a loan in the name of the hotel owner for 7 years, for instance. So the first point there is what we call the original facility, which is effectively a standby letter of credit, right? Given to a loan provider to provide the funding for the construction of the hotel. So as soon as that hotel is delivered, we pay off the loan provider and then provide a facility for the furnishing of the hotel with the real estate as security. Right? Then we take the risk of the operational cash flow of the business. Well, this is what I was trying to explain, the original facility, which is effectively the SBLC, and then the relay facility, which is the refinancing of the SBLC and the booking of the loan in the name of the hotel owner. Yeah, so what this does is the borrower is able to access funding of up to 10 years because the SBLC is given for a 3-year period. Then after that, we'll book a loan for 7 years. So this is a way of overcoming the challenge of 2-year money that is available in the market. Again, the property that the borrower owns is used as the equity in the business. So we may not require additional funding from whoever is planning to build a hotel. Yeah, so these are the processes that has to happen. Eligible countries that we can do are all our member countries. You can access these on our website, or I can email them to you if you are interested. Now, however, we can fund projects in non-member countries, as long as 60% of that entity is owned by a company in a member country, or 40% of the value added can be traced to a member country. Again, being an African financial institution set up by a charter of the African Union, we have to be seen to be promoting Africa. Therefore, 30% of the content measured by a combination of rent, interest, wages, or profit should be retained within Africa. Yeah, I think you can read this up. All right, thank you.
No, you will take it on.
Yeah.
I'm afraid time's up if you can't agree.
No, that's fine. What we will do, I will introduce him on that, and then we can share, because exactly the hospital is the same concept.
Yeah.
But so I will let him continue, take
Yeah.
about 5 minutes of my time, finish with the case study, and then I will just introduce with a different case, but which is related to
Yeah,
that.
and just to make a point, both cases are on HomeStrings as investable projects.
Exactly.
Yeah, I was just going to say, those of you who haven't picked one of these up, it's online anyway, which is a summary.
My name is Samuel. My question is very simple. We are a UK-based company with a good strength in Africa. I'm always in and out of Africa, and I can tell you the cost of hotels are extremely unbelievable. And most times when I get the chance to speak to the management of the hotels, most of them always have this view that the African governments, both the governors or maybe the ministers, they always have a relationship, a form of contract with these hotels. And most of them somehow abuse this trust. Most times they will use the hotel, they will send an invoice, and the hotel will never get paid. How do you, thinking in that line, to manage that kind of system in Africa?
Okay, thank you for that challenging question. That's what we're here for. No easy tap-ins here. So in the absence of any other questions, if you can address the second question first and then the first question second, and that will lead nicely on to the next presentation.
All right. This product is designed effectively to overcome challenges such as that. What happens is before we issue our standby letter of credit, which, as I said, is the first step in the process, we must pre-qualify a hotel management company. What you highlighted is very common, and it's not just in hotels in Africa. We've seen it in airlines. Nigeria Airways was effectively liquidated because of things like that. So a Hilton hotel, for instance, will not get involved in such a practice, whether a government or not. Obviously, whoever owes would have to pay. So that is why that is an integral part of our process. So we have to pre-qualify a reputable hotel management company who will manage the operational phase, because that is the risk we are taking. For the person providing or the lender providing the construction loan, that lender is effectively taking our risk. Because what happens is, as long as they deliver to specification, they draw on the SBLC. I will book a loan in the name of the hotel. Yeah.
Okay, thank you, Humphrey. And Humphrey is now just going to show a couple of slides to answer your point, which will lead on to Francois' presentation.
Yeah, who was that?
The previous.
My presentation.
Needs a yellow card.
So this is a typical case of, indeed, this was the first transaction we did under the contour structure, and it has won awards, at least 2 awards that I'm aware of. It was formerly called Capsera Hotel in Freetown, Sierra Leone, but was going to be managed by Hilton because Capsera acquired the rights or concession on the land and came to us for financing. Obviously, that was limited. Well, so maybe I should go slide by slide. So this is the previous Capsera Hotel on the left that was demolished by funding provided under the structure. Then the final product will look like what is on the right. Now, the principal terms, as I said, Capsera Hotel acquired, won a concession from National Social Security and Insurance Trust, which is lessee of the government of Sierra Leone. The construction loan was provided by FBN UK on the back of the standby letter of credit provided by Afrexim Bank. The hotel operator would be Hilton International. It was a total of $41 million facility, 35 of which is by way of SBLC, which is what is required to deliver the building. Then $6 million was going to be for the fixtures and fittings as the furnishing, and then working capital available for the hotel operator. Yeah, because of the ownership structure, we insisted that the government of Sierra Leone enters into some form of direct agreement with us and then the lender, which is FBN UK in this case, to avoid a situation where if they're ignorant of the fact that a new owner has interest in the land that they've leased to the NACIT, then it might pose challenges for us. The groundbreaking ceremony actually was done by the president of Sierra Leone. Yeah, so these are the specific terms. I think they can read. They can read this up if you provide the distance. Yeah. So I think that is the what is all about.
Great. Okay. Thank you very much, Humphrey, for that. I think my conclusion from that is there's a lot to read and take in. Looks quite complex, but it also looks extremely thorough. So again, all the details are on the HomeString site, so you've got plenty of time to download and read at your leisure, and obviously you've got people you can talk to get more information or explanation. So, Francois, perhaps I can ask you, you've now got 30 seconds left, but perhaps if you've got a bit longer, if you want to come up. Francois, who we heard from earlier, is going to talk to us about a specific example which again is on the HomeString site. It's the Ghana Hospital construction site. So I think this is going to be equally fascinating, and hopefully will also explain, if you remember what we've just heard about the Sierra Leone Hotel, you can apply some of the lessons, and if anybody needs a good optician, perhaps they're quoted on HomeStrings as well.
Okay. Can you hear me? Yeah. Basically, I'm not sent since the details are available, so I'm going to skip. I don't know. You know how to use this stuff. Yeah, okay, so if you go next to page. Yeah, that's one. I'm just going to follow up on Humphrey's presentation. And the hospital case is similar, but perhaps I know that ADB, African Development Bank, is here, so I'd like to get their attention a little bit. What was interesting on the Cape Sierra example was a typical case where you have African entrepreneurs. They have land, they have a great idea, they have a straight business model, they know how to do these things, they can execute, but because they have limited resources, and quote-unquote, they were discriminated. And unfortunately, the support didn't come up from the DFIs, which are supposed to be as part of a developmental institution to support African entrepreneurs in this particular case. And I was very disappointed, at least from my perspective, from quite a number of DFIs. And the reason we landed with Afrexim on the contour was effectively develop some kind of financial engineering to address that gap. And thanks God, Afrexim responded favorably to that. Humphrey has run you through the mechanics. Ultimately, the whole problem of contour, even if you look at the hospital, is very much how do you help an entrepreneur who's specialist in his field, in this particular case, the hospital, to do what they do best, i.e. build an hotel or build an hospital and execute with limited constraint. As far as I'm concerned, that's what Contour enabled you to do. It's a lot of financial engineering, build around it. Basically, if you go to the next page, in fact, the financing approach within the Contour, oh, sorry, not this one. Okay, I think I'm going to take it. Doesn't matter anyway. The key approach within the Contour is effectively split all this construction financing is split the risk between construction risk and operational risk. And the reasoning being that some people are comfortable with construction risk and some are not. In the case of Afrexim, they're comfortable with the operational side in the face of, and then the other institution on the construction. So what we did then is, how do you balance that? How do you target investors who are comfortable with the construction risk? And how do you address the fact that there's a limited amount of capital into the deal structure? So on the construction, with like all transactions, which is what we're doing on the hospital, here is a $60 million project. Basically, we're saying, okay, if you look at the operational side, institutions like Afrexim are comfortable with, what we're going to need to demonstrate to them is that we can find an operator who is capable of managing the hospital the same way that we were capable of finding an operator managing the Hilton, being Hilton, and then you have an alignment of interests, and that there's no free lunch. Now, that doesn't solve the problem of the equity, because in their case, they have a loan-to-value ratio of about 75%. In other words, they're not lending you the full value of a property. So there's going to be an element of capital. Now, when we move back to the construction side, the construction lender is saying, fine, great, but the sponsor have to have a skin in the game too. And one of the things that we did, in fact, on the Cape Sierra, and we're doing the same here, is to align the interests of contractors with those of the lenders. And one of the key aspects that we develop basically is to tell the contractor, guys, the sponsor have a line, they have limited amount of capital. We want you to provide us some kind of equity substitute by way of subordinated contractor loan during that period of constructor. Effectively, we're telling construction companies, guys, you're underwriting your own risk because you're the one building the contractor. So if you think there's not going to be a problem, you can give us a strong construction contract which have fixed price, so we don't have cost overrun. Second, you can deliver on time, and you're the one managing it, so you shouldn't have too much of a problem on that. That's exactly what was done on the Cape Sierra with Flagan, and that's exactly what we're going to do on the case of hospital. Now, to make the lenders on the construction side to feel comfortable, yes, there is a refinancing and exit element by way of an SBLC, which Afrexim is saying, fine, you deliver a completed hospital, completion meaning built and furnished. Well, in the case of a hospital, it will be with the medical equipment furnished. I will then take out the lenders out of a picture. So the key aspect was from a contractor company was, okay, how do you get us out? Because we're not in the business to invest. We're happy to underwrite the risk, and we want to be out once we have delivered, i.e. we built the hospital, or we build the hotel, and so on and so forth. So some of the structure, and I think, Humphrey, something that we're probably going to be discussing with you, with Afrexim, is to take the contour structure to a slightly different level, where all the bits and pieces can be put together, particular, help the contractor get out the same way that the construction lenders get out of a way, because it's all the same risk. In the case of a hospital, our analysis is that the contractor lender will obviously have to feel comfortable with the construction risk, contractor risk. And what we are doing in the case of a project, which again, Homestring is involved in Nigeria for the hospital, is putting a full completion guarantee by a local bank who will say, guys, don't worry about the contractor. We will take on that risk to enhance the whole transaction to bring it down. Now, this is the structure we discussed, for example, with quite a number of development financial institutions to help address that equity shortfall, because all this thing is, to tell the truth, is that there's not enough equity. The guy cannot come enough equity, but they have the land, and there's a value behind it. And we didn't see that reactivity. We saw it from Afrexim, and I think that was a great notion. So the idea would be to expand it from hotel to hospital, which is medical tourism. So I think I'm coming close to my time. But so for people who need more information on the project itself, it's $60 million, it's a 100-bed hospital. I think the healthcare story in Ghana, in Africa, is known. The healthcare sector is a poorly financed sector for probably many reasons. One, I guess, on the healthcare is that, first of all the healthcare words are so technical, very difficult to pronounce, that maybe bankers, we just can't pronounce it, so we might as well not touch upon it. But also it's one sector where, because it's always been government-owned, the private sector and the financial system simply doesn't finance that parameters, and yet the developmental impact in healthcare is huge. The loss of capital, because all of us here, we travel abroad to get to to see our doctors or to get taken care of. So there's a loss of foreign exchange in that particular segment. So our view is that demand for healthcare is there. The consumer, the African consumer growth story is behind it. So if people can use their mobile, of course, they will take care of themselves. So we think, coming back to Humphrey, what he was saying is that on the operational side, they wouldn't have a problem on the healthcare, because we know that the cost of healthcare is an affordability issue. It's very expensive. So the way we are addressing, for example, in this particular project is to say, fine, we give lenders and investors visibility on the revenue side by signing various agreements with insurance companies, so that when you go to the hospital, you're being covered by the insurance and the hospital will get paid. Now, in the case of Ghana, we know that, for example, the National Insurance Corporation is not a very, very good payer. So if you have a government taking a risk there, sorry, I'm almost close, then we will manage that particular risk. I think this project is profitable, certainly for us. There's a mezzanine piece into the transaction, and there's a senior piece. We reckon that the mezzanine piece would give an IRR of 20%, and that's consistent with a return of 22% on real estate. And we think that investors, if they put in the equity money, can get something like 5 times their initial investment. Okay, thank you.
Thanks very much indeed for that, Francois. I think actually that's a really good example of how something actually should be of interest to the diaspora, and actually probably where diaspora understand how paying for health is actually a fundamental part of life for many of the diaspora anyway. So it's something that they can both contribute to directly, but probably as customers one way or another, but also get a return from investors. And as we said, there's a lot of detail on the site. Is there any questions for Francois? The gentleman there. Thanks, Natalia.
I'd just like to know a little more about the hospital, if you can. I mean, like, is it a state or private hospital? Where in Ghana is it? When is it expected to be completed? And what departments will it be serving as well?
It's obviously, I'm not from Accra. It's not very far from the airport. That's what I know. I went to the site myself. It's a privately owned specialty hospital. Basically, it's going to focus on neurology, ORT, gynecology, cancer. Basically, referral will come from other hospitals. So it's very much a specialized hospital, because in Ghana, as you know, specialty services is basically, it's provided on a limited basis.
Okay, thank you. Yeah. You're probably going to respond to his question.
Yes, of course. I'm not going to let that go. So, first of all, let me explain a little bit about hotel and hospital business. I mean, this modality actually works with African Development Bank as long as you bring some kind of construction equity in place, because we are not created to basically put this kind of investments in the projects. When it comes to the hotels, actually we did number of hotels at the early days, but you have to realize Africa needs every year $100 billion investments in infrastructure. So everybody has to focus in certain areas. For us, actually, hotels are not really considered as infrastructure. While the continent needs both public and private infrastructure projects prioritized and delivered in many areas, from transport to energy. You know, we are a dark continent, so hotel comes actually not a priority for us. Another point you mentioned, and I fully agree with you, and I think it is something missing in the market, which is the construction risk financing. Once actually construction is over and projects are operational, it is very easy to find equity investors. So that's why under our charter, we cannot do construction financing alone, but in the new vehicle, we will be focusing. There will be one product offered to actually investors, will be construction risk financing. Either providing a risk product or taking the construction risk, delivering the project, and basically exiting after the construction. You mentioned that Africa Exim Bank was there. Actually, I'm glad to hear that. And we want to see Africa Exim Bank to grow even further. Africa Exim Bank was created by African Development Bank. One of the reasons actually we supported creation of Africa Exim was because we cannot provide those products ourselves. So that's why actually we are clearly happy to see Afri-Exim is filling the space it should be filling in the continent, and we are ready to do anything. We are still a shareholder for them to grow even further. So as you see, different institutions are coming up to hold hand of the investors. I think we are still interested in talking to you about the hospital business. Since I will be doing the business development, I will be happy to talk to you.
Okay, excellent. I think there's one more question there just behind, I think. But thanks very much for that response, and that's a good illustration of some of the good things that can happen at these types of events. So clear answer and also a way forward. Excellent.
Thank you, Tas.
Hello, my name is Stephen. I'm an entrepreneur in the health financing business in Africa. I can see clearly that healthcare is going to be a big thing in the next 5 or 10 years to come. I just wanted to check with Erico and Afrexim, how willing are you going to be in the future to finance more and more of these health projects?
Depends whether you get your checkbook out, I suppose.
Okay.
I know you mentioned about unfamiliarity and government funding and all the stuff that's hampering you, but how willing are you going to be, and what environments do you require?
Well, I mean, on the healthcare, we have the Ghana project is. There are 2 projects live right now. One we're working with HomeString is in Nigeria, but it's exactly the same concept. And I'm very pleased that some of you who have supported HomeString has basically signed a term sheet along with other institutions. And in fact, the team was in Cairo 2 weeks ago with basically Afrexim is just putting together all the paper to take it to credit committee. So that project in Nigeria is fully funded. And so I would say thanks to you via HomeString, clearly you're there to address the need for healthcare. So the Ghana project, I will hope very much that Eric will again support that particular project as well. It's a different business model. As I said, it's a specialty hospital versus Nigeria one, which was general. But my thinking is that, as Tas just said, if the idea is that they cannot take construction risk, my thinking is that once you have an hospital which is built, equipped, ready to run, everybody will want to go. So therefore, the equity risk and the potential upside is even greater. So the business case to make that investment becomes even much stronger. And what they can do, perhaps a request I can make to us, will be that in your charter, you allow, for example, refinancing mechanisms, because some investors, I don't think HomeString, for example, will want to invest for 10 years. So it's a reality of a grant that we need to recognize. So we all have to work hand in hand to come to finding a solution towards the shortages of good quality hospital in sub-Saharan Africa. And second, if we can then manage to save money for an exchange outside, which remain in the country, everybody will be happy. And the cost of healthcare will be more affordable.
Okay, Francois, thanks very much. I'm going to have to stop there only in the interests of time, but it sounds like you and Tas are going to be having a few conversations in the near future, and I'm sure we'll all hear the outcome. So now I'm delighted to pass along to Daniel Brody. He is from Silk Invest. He's the Chief Investment Officer. Thank you very much for being with us. I know you had quite an incident-packed journey, which I'm sure you'll tell people over coffee. If you can squeeze it into your time now, fine, but otherwise, if nothing else, that's a good reason to talk to you. So the floor is yours.
Sure. Well, actually, I just come from Morocco, and sadly one of the people on the plane was arrested whilst we were on the plane, and therefore I wasn't actually able to attend last night's dinner. But what I was doing in Morocco was actually very related to this investment conference, in as much as I was looking at mass affordable housing and affordable housing in the Moroccan context, which we're going to do effectively concept transfer into Nigeria. So effectively units of housing at 25,000 euros in the mass housing market, where you can actually make decent returns on providing housing units at that level, and the affordable housing, which means the sort of mean housing cost at about 250,000. So from a Nigerian context, very interesting when you transport that sort of concept to Lagos. So what I'm going to talk to you a bit about is why real estate in Africa? Why should you care? And in that respect, I just thought I would share with you some data points, just so that you understand why we're all doing what we're doing, why we're all very excited about the opportunity here. Now, it's not rocket science. I think the way to spell it out is to just point out one statistic. 2025, there are going to be 1 billion Africans. We, in Silk Invest, like to call it 1 billion consumers. But hey, let's take one step back from that number, because billions are difficult numbers to understand and comprehend. Let's talk about the fact that of that billion, half of them are going to be under the age of 25. In other words, those consumers are coming into a marketplace where they need accommodation. Effectively, they need housing. They also need hospitals, they also need schools, they also need all of these other things like shopping centres. But the residential opportunity across Africa is staggering. Now, we at Silk Invest provide investment solutions, and you're going to hear later from one of our equity fund managers on what we're doing in equity in Africa and in West Africa in particular. We also do fixed income, private equity, but what I'll share with you is why we're so interested in the real estate space. So, there are only 6 bullet points. I've been told that most audiences can only retain 3 bullet points, so I'm going to really tax you here with the 6 ones, but they're very easy to understand. Effectively, it's all about these people. So let me come into these people and tell you a bit more about them. So take a look at the first chart here, the population by the region. So we're here talking about West Africa. And you can see the share that West Africa has of the whole of Africa is actually quite a significant one. Again, difficult to conceptualize numbers, so let me give you an easy takeaway number. In Nigeria, there are as many babies being born this year as there are in the whole of Europe put together. And think houses. So there you have the numbers. Absolutely staggering, and as you know, under-provided for. At the same time as this, you have another dynamic, and that dynamic is changing the demand for housing in the urban areas. What's that? That the people in the rural areas, the farmers, don't like being poor. They can see the wealth being created in the cities, and they are upping sticks and going to the cities. Quite natural. We've seen it happen in every country that is industrialized in the world. It's a long-term process, and it gives you a lot of visibility. We know it's going to happen. We know it's happening. And as it happens, it drives up the prices of residential in those cities. So in that respect, urbanization is a very dramatic theme. And as you can see, right there at the top is Lagos. So we have one of the most dramatic urbanizations going on in the largest city in West Africa. Sadly, these cities weren't created for these large numbers of people, as we've heard, potholes on the streets, lack of hospitals and the like. Fortunately, people like the Africa Development Bank and many other organizations, and particularly as these countries are improving their tax take and so forth, are now spending on infrastructure. But there is clearly a situation where the majority of people live in substandard accommodation. Now, That has to be addressed, or what happened in North Africa is going to happen in sub-Saharan Africa. So either you buy the story that industrialization will create growth and that money will be plowed into these countries and that they will grow their way out of their problems, or you're a pessimist. Now, I'm an optimist. I believe that actually what we're seeing in Africa right now is a pace of growth sufficient to not just increase the wealth in terms of GDP, but increase GDP per capita in a significant way. In other words, it's increasing wealth. And that is where the story lies. And again, that's where the story lies for residential. So let's look at this in terms of the actual number of units needed over the next 10 years. And now these are conservative numbers. 29 million units required in Nigeria. Hey, there's enough room in this marketplace for me, for all the guys on this panel, and all of you, and 1,000 other companies. And we're all going to make money, and we're all going to make decent returns, and way more than this 22% that you've been told is going to take place in the shopping center sector. So how do we go about capturing that? Well, that's where the trick comes into it in terms of how you go about on project developments, how you go about on financing, how you go about effectively marketing this, how you provide financing solutions to those people who need to buy these properties. Because when you don't have a banking sector, when you don't have a mortgage sector, which is more than 1 to 2% of an economy, you actually tend to find that it's a cash buying market, and therefore you actually have to do quite a bit to facilitate your demand side of the equation as well as the supply side of the equation. And that's why when I said what we do at Silk Investors Investment Solutions, you have to think a bit out of the box as to how you're going to provide all of these tens of millions of units at obviously an economic profit. So this is the good news. The good news is, as I said, its GDP per capita is increasing. You all know, because you're here, the investment story for Africa, the fact that there's a new democratization, the fact that there is a returning diaspora. Not everyone is here in London listening to presentations about how to make money in Africa. A lot of people have returned and are doing so. And in that respect, we're at the tipping point. Now, this has happened, as I've said, in every industrialized country that goes through a process of industrialization in the world. It happened in Europe, in our industrialization. Even in America, they had to go through a process of industrialization and incidentally went through a sort of civil war in the process and the like. Even in Asia and even in India. All these countries have gone through it. But once you get to this GDP per capita where Africa is now, that's the sweet spot. That's where things happen. And that's why everyone's really very interested in what's going on here now. And in terms of the investment delta, you can make your money, obviously, with a lot of visibility in the public markets. And there are now a number of public markets you can get access to in terms of equity and fixed income in Africa. There are a larger number of sovereigns that have sovereign ratings in Africa. Private equity is also very interesting, but the sort of visibility and the security you get from real estate is second to none, although obviously it is an illiquid asset class, and that's the caveat emptor that obviously one has to say with any investment presentation. So in terms of the cumulative housing demand, there you have it against the per capita GDP. You can see where the interesting places are. And once again, Conference on West Africa, it's not surprising that we're looking to Nigeria to capitalize on this trend. And you've already had the question on REITs. REITs are going to be a very important development. The REIT sector in America is a multi-trillion-dollar sector. It's a €1 trillion sector in Europe. There is now a very growing EM REIT sector. There is no international REIT for Africa, brackets, yet. Watch this space. And in terms of local REITs, there are now 2 established listed REITs in Nigeria, a couple of REITs in Ghana. Kenya is coming hot on the trail. South Africa has a bit. But that is pathetic for a continent the size of Africa, and this is going to be the next investment theme. In fact, I've written an article about it. I've shared it with the conference providers. If there is if we're sharing presentations and publication materials afterwards, then I'm happy for that to be shared with the audience by approaching the conference organisers. Or, of course, you can look at our website. So there you have it, short and sweet. Nigeria, the hotspot. Compare it to Morocco, where I've just been, as said, real interesting opportunity as to the takeoff time and when the time's right to invest in these sort of concepts. The housing deficit's there, so it's not just a demand story, it's also a supply story where supply has yet to be met. So it's not rocket science, it's obvious. Either these people are housed or they're going to be changing the whole future as we know it, and I personally believe that we're going to house them and that they're going to be housed at an economic rate that provides a decent return to investors. Just from the point of view of where we're positioned, which is affordable residential, just point out that affordable doesn't mean not making money. What affordable means is affordable to the median income earner. Now, obviously, a median income earner in Africa is very different from a median income earner in Europe. So we're not talking about being able to sort of scrabble together £250,000 to buy a two-bedroom flat in London, which is the median affordable level for London. We're talking about much lower entry levels in Africa, and obviously lower construction costs, so therefore able to achieve that at a different sort of economic rate. Clearly, there are risk factors. We know there's corruption. We know it's hard to transfer property ownership. We know that getting the infrastructure, which was mentioned in one of the questions, is a problem. Just even getting sewage to a brownfield site, and that's the terminology that's used in the marketplace, I'm afraid to say. Even getting that may involve challenges with regards to local authorities and politicians who have heads bigger than their desks. Certainly there are law and other challenges that have to be done, and also the current mortgage rates and so forth are prohibitive. So financing solutions, whether it's the African Development Bank or some local banks providing some sort of assistance or solutions on mortgage provision for the mass market, or even people like AMCON or whatever, these solutions have to be addressed and addressed by Africa collectively and the African institutions. So there you are. That's it. Just to give you a flavour of why we're all interested in investment in real estate in Africa, and particularly the residential real estate.